Juliette, and today I will explain you how do I assess and how do I manage the risks within DeFi. So as you know, DeFi, it's not a matter of when, if you will lose money, sorry, but when. And in this lecture, I will present you a framework to assess the risk at each level. So a strategy composes the strategy itself, the assets, the protocols that we are using, and of course the blockchain it relies on. I only have 30 minutes. Usually I give this kind of lecture for a few weeks because we have to analyze and to understand how all the protocols and how all the asset works. So I will show you the big picture, a big overview. And for the one who are interested into more details, you can ask me questions after, or you can contact me. Also, I can share some documents and some Excel spreadsheet that I'm using for my risk management. So for who is this presentation? If you want to deploy strategy in DeFi, but using different protocols. Of course, if you only want to deposit funds into Aave, if you want to give your funds to a curator or a hedge funds manager or whatever, you don't really care. Or if you're a pure DJ and you just want to ape in any kind of strategy that you see. But if you want to level up your DeFi strategies, your DeFi yield, the way you manage your money, then this presentation is done for you. But before to start, just a small mathematical reminder. It's pointless if you put all your money into Aave, for example, so 96% of your capital, and you're gonna make 5% per year. And you just say, okay, I want to just risk 4% of my capital into a more risky strategy that can yield, for example, 20%. Well, it doesn't make sense because if you do this, you will just end up making 0.6% more per year while you are risking 4%. So you always have to think this. Does the risk does the reward worth the risk? So personally, I'm not using Aave, or I'm using it for a very specific purpose. It's where I borrow money against my wrap BTC. But I don't use Aave to generate yield. I prefer to invest in different strategies, many strategies, we're going to speak about it a bit later, which are a bit with a higher risk, but I manage my risk in a way that it is worth the risk that I'm taking. And in average, since 2022, with stablecoins, I have done around 22% of yield per year. I don't speak about the performance of the portfolio. Of course, with ETH and so on, it goes up and down, but pure revenue. My name is Pascal Tallarida. I work with a free project, Jarvis Network. We do stablecoins. We do on-chain FX. We are mainly on Base. 73 Capital, it's a DeFi fund in Luxembourg where for investors we are managing Bitcoin, ETH, USDC and also Euro stablecoins from where we do yield strategy. And I also work with Alyra, which is a French school. And for Alyra, actually, we have developed the first French lesson for DeFi, which received the certification from the French administration. So today in France, actually, you can follow lesson and to receive the equivalent of a diploma in decentralized finance. So DeFi, for the one who were there in 2020, you may remember Yam.finance. It was very easy. It was for retail, and it was basically a playground. We were just depositing money into a liquidity pool. We were making super high APR, and the only things that we had to be afraid of was a hack. But that's all. It was the only things that we had to do. Today, of course, DeFi became a very complex, fully fledged financial ecosystem. And who says financial ecosystem says financial products, derivative, insurance, and so on. And now it's actually more complicated to use DeFi if we want, of course, to go a bit out of the Aave and so on. And this is why I wanted to do this lecture today. And when I mean the risk, I don't mean about the risk of a hack. Of course, there is a risk of a hack every time. But today, we won't speak about the risk of hack on a protocol. It's not a technical presentation. I will only speak about the financial aspect of the risk management. And as I said before, you have many different strategies which are on the spectrum from the low-risk strategy like staking ETH on Lido to a more risky strategy like doing some looping with PT and on Morpho or to do some delta neutral. And the idea here is how we can manage the risk if we only want strategy which are a bit high risk and a bit more complicated, but to don't take too much risk so we are sure that at the end of the year we finish in profit. So first, let me walk through the general principle of the framework. So the first thing you have to do in your head is to divide a strategy into several components. Me, I'm using 4 components. So let's take an example of a very basic strategy. You lend USDC on Aave. So here, lending is a strategy. When you lend money, we're gonna go over it after, don't worry. I will, now just a quick introduction. The strategy itself has many different sub-components. For example, the risk of lending, what is it? The execution of the lending strategy and so on. Then the asset, the USDC, it carries its own risk. The protocol we use here, Aave. Also the blockchain, of course, we are there. Then the second principle is that we have to create benchmarks. So me, I'm using from A to F. We're going to go over it after. So, of course, A will be the less risky strategy, B will be the low-risk strategy, and all the way down to F. So we need to create those benchmarks to classify the strategy that we want to do so we know what is the position sizing that we are okay to do. Then, like any people who are experienced, even if you have the experience, you always need to have a decision tree or a check notes. You know, pilots, they have flew thousands of hours, but yet they still have to do the checklist before flying the plane. So it's the same for me, it's the same for you. Me, it happens sometimes that I'm tired. If I don't check my checklist, I can make mistakes. I have made mistakes a few weeks ago, even though I'm used to, because I was too much in a hurry to do something. So do checklist, do a decision tree. It will help you to respect the framework that you have put. Simulate, track, and monitor and report. So I know this is very bothering, but you have to know that if you want to, again, do very simple strategy in DeFi, deposit money in Aave, you have basically nothing to do. You just deposit your money. A few years after, you come back, your money is still here, you have made money, and that's all. It's not time consuming. If you just buy a PT on Pendle, it's the same. You come back 3 months after, and the money, hopefully, is still here. But again, if you want to deploy more strategies, it's actually a full-time job. So you need to track what you do. I have Excel spreadsheet that, as I said, I can share with you. So you can just send me a message on LinkedIn, Twitter, or whatever. And I can send you my tools. There are also videos that explain how I'm using them. It's in French, so for the people who are interested and who speaks English, I will do a video in English, but it's not ready yet. So yeah, just contact me. And what I do with those Excel spreadsheets, so I'm tracking everything. For example, if I take a loan, I write how much I have borrowed, so I know I can track how much I have to pay interest. Every time I do a swap, I write it. All the strategy, everything, so I know every time what I'm doing, how much I have invested, how much I have paid, and so on and so on. Secure your assets the proper way. I won't go into detail here because it's not the point of the lecture, but if you really want to be serious about the way you secure your assets, don't just use a ledger. You have to learn how to use Gnosis Safe plus a ledger. You have to use a Rabi because Rabi can help you to simulate transaction, to see whether or not the website you're using is legitimate. And some tools like Den. I like Den because it's basically a tool when you use Gnosis Safe, which helps you to reproduce transactions that you have done in the past. It's super useful. For example, if every week you have to claim some rewards, you have nothing to do. You go on Den, you check your claiming transaction, up, you re-execute it, and that's all. It allows you to avoid mistakes, and so on and so on. And of course, you have to do your homework when you are a DeFi investor. Again, if you really want to be fully into it, but you have to do research, or you have to use ChatGPT. I'm using it a lot to do some research when I don't know stablecoins, for example. I use ChatGPT to gather the best source on internet, and then I dig more. So, for example, I go on the Git book, on the documentation of the project. I also go in their Discord. I ask questions. If there is a red flag, I stay away, and so on and so on. And then here, I don't know from where you are, but me, I'm living in Eurozone, so this year has been very challenging in terms of yield, because most of my assets are in USD, and of course I'm losing money because this year euro-dollar is up 17%, and I didn't make 17% with my USD so far this year. So you have to learn how to manage your FX risk, and this also I can speak about it if we have a bit of time at the end of the lecture. Okay, so the components. As I said, I like to divide strategy into different components. So here I gave some example of some strategies. So you have, again, the asset, the strategy, the protocol, and the network. So this is how I make my analysis of the framework I'm using. So for the asset, I will look into the access. How can I access this asset? If I can buy it, if I can borrow it. The design of the assets, and the admin key. So access, it's, for example, liquidity. So remember that you always have to wonder, from where can I get this asset? You can get it from the primary market, you can get it for the secondary market. What is primary market? So for example, for USDC, you can get it from Circle. From another token, for example, USDO from OpenDollar, if you know it, you can get it for OpenDollar, but you need to pass a KYC. So the access is not that easy. So you have to go for USDC and for USDO into secondary market. Secondary market are basically DEXs. But every time you want to acquire these assets, you need to make simulation. You need to check where the liquidity is the best. You need to pay attention to the price impact, the slippage, and so on. This is what I'm doing. So for example, I'm doing a lot of strategy with something called C token. You know, it's a token that has an exchange rate and they grow in value over time at each block. Well, the problem of C token is that most of them, they are illiquid on-chain. So you first need to acquire the main token, then you have to wrap it into the C token. But sometimes it's not the case. Sometimes the C token has liquidity on secondary market, but you have to pay attention that the liquidity on the secondary market follows a peg. I will show you a chart after where there was a problem a few weeks ago with one C token that many people used, and people, I don't know if they realize, but they have lost millions, and I will show you why and how. So yeah, I check all of these regulation, of course, if the asset can be held without restriction. Then the design, I'm wondering, okay, what is this asset about? Is it a tokenized asset? Is it a synthetic asset? Is it, again, a C token, a A token, a Volt token, whatever? So if it's a tokenized asset, I do some analysis. Is it cash and short, for example? This is the case for USDC. Is there a counterparty risk? So the counterparty risk is if you have an asset which is collateralized by something, you have to know if there is a risk that this collateral disappear or this collateral cannot be redeemed. And this could be a big problem. So of course, for USDC, the example I have taken, there is almost no risk. But every time you want to use a new asset, a new stablecoin, you really have to make this analysis to understand what is the collateral and so on. Transparency, of course, for tokenized assets, USDC, they have monthly independent audit, collateral managed by BlackRock. So in terms of risk here, it's easy. And then I'm checking the minting and redemption system. Who has the right to mint? Who has the right to redeem? So this is the hardest thing to assess because it's rarely in the documentation. And unless you go to check the smart contract, it's not very easy to do. So the best, if you don't see in the documentation, is to ask on the Discord who has the right, what is the process of minting and redemption, because again, this could be part of the risk. Admin key, again, who has a minting right, is there a possibility to blacklist your address and so on. So those are all the things I'm checking every time I choose a new asset, because I'm not doing strategy only with USDC. I'm using a lot of different stablecoins, and I want to know if the stablecoin is legitimate or no. So here I have made a list of all the risk that I'm checking. So I let you take a screenshot because I can't go over everything. But basically, every time I try to classify what is the stablecoin or the asset, and then I check all the risks. Those are all the risks that I have identified for this. I will send. I think the presentation will be available to download. So for example, it was just end of June. So this is a stablecoin called USDO. It's done by OpenDollar, and like many stablecoins, it's a stablecoin that allows to earn the yield of the collateral. The collateral being bonds. But there is a trick. So first, when you check the way it works, they don't do it themselves. So they buy tokenized bonds from other projects. So it's other projects who are doing the tokenization. And also they are using, they are doing themselves the tokenization of some bonds. So when you check the collateral, the counterparty risk, you know that there is 30% of risk held by this company, OpenDollar. So then either we trust them or no. And then the rest is managed by other people. But the problem for this asset was different. So this is the C token, which means that it's a version that does not rebase. So you still make like 4% per year, but it's because there is an exchange rate. And this in blue, it's the exchange rate. So at each block, the price of the CUSDO is supposed to increase. But Euler, so a money market, has launched a strategy where people can deposit CUSDO and borrow USDC against it, so we can do some looping. You know, looping is the leverage, basically. So you borrow USDC, you buy more CUSDO, then you borrow USDC, and so on. And by doing this, you can make 10, 20, 50%. And actually here the yield was 50%. But the problem of Euler is that they don't check what is the price of the CUSDO, because the price was very far from the exchange rate. So many people did this strategy and they bought the CUSDO at this price, while actually the real price was there. So they were thinking they were making 50% per year, and it's true, they made 50% per year on their investment. But the problem is that they bought the stablecoin super high, so they lost money. And this chart is not isolated. There are many, many C tokens where you think you make a good deal, you buy them on chain, but you don't check if the exchange rate is too much different from the market price. So before doing looping on a C token, on a PT or whatever, you always have to double check if the exchange rate is the same as the market price. Most of the time, usually the market price is below the exchange rate. It's the case for wrap staked ETH, as you know. It's better to buy wrap staked ETH rather than staking. But for some token, it's not the case. And here, the strategy of Euler drew millions into their vault. I think it was 50 or 60 millions. So for sure, many people acquired USDO in those areas. And then when the strategy finished, it was there actually. So you can see the end of the strategy. It was there where people exited the strategy. So they sold back the CUSDO and they sold basically there, and some people bought there. So they actually lost money. So this is why you have to check the way the asset works. Then you have the strategy. So when you lend money, the first risk is the collateral. So remember that when you lend money, you take some guarantee, the collateral. If the collateral is bad, if the collateral is illiquid, there could be a problem during the liquidation. So you have to pay attention to it. So you have to understand how the protocol works. So Aave is easy. It is curated by a DAO, and the DAO is advised by a service provider. So usually on Aave, you don't really have to think too much about it. But if you use Euler, if you use Morpho, they have a different approach. Morpho, for example, it's pure DeFi. They let anyone launch any market with any collateral, with any oracle. So you actually have to do your homework before you use Morpho when you want to lend money. So of course on Morpho, you use curator. Curator are people who are basically like hedge fund manager. You give them your USDC, and they will lend your USDC to different markets, and you trust that they will do a good job for their risk management. But yet, you can't trust blindly. When you give money to a curator, you have to check what is the curator doing with your money. So you have to check against which collateral they lend your money. So you really have to pay attention to the collateral to know if you are willing to take the risk or not. Faulty liquidation. So of course, you only have to use money market which are battle tested. I know it's very sexy when you have a new money market with high yield and so on, but you don't know how their liquidation works, if there are liquidators at all. Most of the time, when a protocol is launched, it's the team itself who is running the liquidation boat. But personally, I prefer to go using a very high and very battle-tested, stress-tested money market. Oracle. So for Aave, it's not complicated. It's only Chainlink. Well, they only use Chainlink. This is not for necessarily something good. It's good to have sometimes a fallback solution. But in that case, there is no problem at all. But again, when you use a money market, you always have to check the Oracle, which one they are using, and if you are okay with it. Liquidity. Aave, as Mark said, it's the only place on earth where you can withdraw $1 billion just like that. So when you lend money, you remember that someone will take your money and will do something else with that. If they don't reimburse, you can't get back your money. So you have to lend your money in markets which are very liquid, and if they are utilized at 100%, yes, you will make maybe a lot of money because the interest rate will go higher, but maybe you won't be able to get back your money. So this is the thing I'm checking. If I have to lend money to a money market, I'm checking all of this. But the thing also is that you don't check it once. You check it when you start the strategy, but then you have to monitor. And if you see that at some point, the liquidity is drying out, if you see that the liquidity of the collateral is getting worse, then you have to take action. So how to monitor? Professionals are using automated tools like Hypernative and so on. If you are just a retail, but just once per day, you can check. It doesn't take that much time actually, the state of all those components. Then there is the execution. So for lending, execution is super easy. You just deposit and then you withdraw. But execution is not always easy. As I showed before with the CUSDO, if you do looping, you have to pay attention to the price impact. I advise you to don't use the automated looping strategy on Alyra and so on, because they don't execute the strategy the best way. It's better to do the loop yourself. Me, I'm doing them myself. When you do delta neutral strategy, which is a very complex strategy, I mean, it's easy to do, easy to understand, but it's hard to do. So the execution here is key. So sometimes execution of a strategy is very complicated. Here again, depositing and withdrawing money is not very complicated. Here, for example, in the execution, there are two examples, two strategies that are different. So the second one, I like it because it uses a stablecoin called MMEV. MMEV, maybe it's a stablecoin you never heard about because it's not really a stablecoin. It's when you deposit in a fund which is called MEV Capital. So it's a fund and they run on-chain strategy. And you can invest in this fund in a platform called Midas.app. And when you invest in the fund, you receive a token called MMEV. So MMEV is basically the tokenization of your investment. And it is supposed to only grow in value if, of course, the strategy run by MEV Capital are profitable and they don't lose money. But the cool thing is that MEV Capital is raising money. So the way they do, they basically launched a PT on Pendle. So you can actually earn a fixed yield by buying the PT on MMEV. And right now, I think it was something like 9% or something like that. And then you can do looping. So you can then borrow USDC, buy back MMEV. And why I like this strategy is because to buy MMEV, there is no price impact. You directly deposit the USDC into the smart contract, and it means the MMEV at the exchange rate. So in terms of execution, this strategy is perfect. The only price impact we have is when you buy the PT. But as you know, PT, they use a highly concentrated pool, so the price impact is actually very limited when the liquidity is high. And here the liquidity is not that low. So this is a strategy I'm running, for example, and again, I like it because the execution is very easy, there is no price impact. On the other side, you have this strategy which is way more complicated because you have two price impact to take into consideration. If you want to run this strategy, which currently pays around 18%, you first have to acquire the CUSDO. And I showed you the chart before. It's very volatile. You cannot access CUSDO on the primary market if you are not KYC'd by OpenAden, which I'm sure it's the case for most of the people. So you always need to go to the secondary market. So you have to pay attention to the chart I showed before. You have, before to run into this strategy, to check if the price on secondary market is the same as the exchange rate, and then you have the price impact on the PT. So this strategy, even though the reward is higher, we may think it's more risky. Actually, no. In the execution side, this strategy is fairly easy. On the execution side, the other strategy has a bit more challenge. Then the thing that many people don't pay attention to, it's the yield. It's part also of the risk. From where comes the yield? Who pays the yield? How long the yield will be paid? So for example, I will show you a first strategy, but for AAV, we know that the yield is organic. It's not incentivized, it's just market driven. The token, but here it's easy, it's paid in USDC, it's paid in kind. But if it's paid in another token, you have to check the liquidity of the token and how this token works and so on. Distribution, but here it's per block, but you know sometimes distribution is for 1 week. So for example, sometimes people see a pool in Aerodrome, it's a Tuesday evening, oh super, I will go into it, there is like 20%. They ape, and no, because the rewards are paid from Wednesday to Wednesday, and then the day after you wake up, you have 5% APR. Basically, you have lost time, you have lost gas, and so on. So you have to always to think, okay, how long the distribution will last, and so on. And of course, the duration, because again, sometimes it's very slow. So we can check two strategies which are not interesting. So even though this one pays 568%, we have to understand from where the yield comes. So there is a small stars here. So by checking the stars, we see that actually the yield is also paid in Euler token and in Turtle points. But it's very small. It's like 2-3%. So from where comes the 568%? Well, if we check, it's because right now, when I took this screenshot, the pool is highly utilized, which means that there are many people borrowing USDT. So by depositing USDT and then looping to borrow USDC, we make a lot of money. But we know that this will just last few minutes, maybe a few hours, so this is not interesting. And this one, the yield was very high a few weeks ago, it was like 50%, but the problem here is that it is paid in a token called Usual, which has a very big down pressure. So if you start this strategy, you will basically do looping, so you will buy USD0++, then you will borrow USDO and you do this. But the problem is that because the Usual token goes down, the yield of the USD0++ goes down, and now we only got 13%, which is okay for some people, but when you enter in this strategy and it's a 50% yield, and you buy USD0++, which also lost value, this is very risky. So again, if you don't question yourself from where comes the yield and what can go wrong with this yield, you are missing some question marks. So again, another list of all the strategy that I have identified, from where comes the yield, and all the risks that are identified. Again, I can't go over everything, but then the component of the protocol. So first thing is the code. But this I will go over it because I don't think that we are a lot of technical people here, but you have many things to check. If you really want to check a bit the code of the protocol, is it audited, is it tested, is it formally verified, is there a bug bounty in place, is the code immutable, and so on and so on. The design, you have to understand the design of the protocol. So for example, Aave use general pool, but they also have isolated markets, so you have to check which one is being used when you lend your USDC. The liquidation system in place in Aave, the Oracle, and so on and so on. So you have to understand, of course, the protocol and to assess if there is some points that could be risky or no. The dependencies, some protocols are dependent on other protocols. So the protocol could be very good, but if they have a dependency on a weaker protocol, then it can go bad. They can also have inherited bad debt from the past. If the protocol is battle tested also, it's true that when you have a high TVL for a very long period, it means that it's safe. Why? Because you can be sure that many people in the world try to hack it. When you have Pendle with $1 billion, when you have Aave with $20 or $40 billion, for sure everybody in the world try to hack them, try to steal their money, yet they didn't succeed. Maybe they will at some point, hopefully no, but it's very good when you see a high TVL for a very long period. It means that many people try to hack, but they didn't succeed. So this is a very good point. Then the governance, you have to check if the governance can change some parameters that can, of course, impact your strategy. Is there some insurance in place in case something goes wrong? Do they have a good treasury? And so on. And the last component, of course, it's the blockchain it relies on. So this, I won't go into details, but basically, you know that some blockchains are more risky than others. Layer 2 are more risky than layer 1, and so on, and so on. Then you have to create a benchmark and so after you have decomposed all your strategy into all those different components that you have checked all those different components, then we need to give a note to know how much money we should put in and whether we should or not. So for example, me, I'm using this system from A to D where I classified strategy. So by default for me, when I lend money, I say that it's low risk. I don't say that lending money is low risk on every protocol. I say by default, when you lend money, it's not considered as a super risky strategy. But of course, if I lend money on Aave or I lend money on whatever new pancake lending market, whatever, I mean, I don't take the example of pancake swap, it could be more risky. So this is my default benchmark. And then what I will do, I will attribute points to each component. So for example, I will give +1 or -1 to different components. So if we take the example of the lending, so as I said, lending, what we have to check the collateral, the liquidation, the Oracle, and the liquidity. Well, on Aave, it's good everywhere. The collateral is high quality, so +1. The liquidation is very good because it has been battle tested, +1. The Oracle is Chainlink, allez, +1. The liquidity is awesome, so another +1. So the maximum to get it's 4 points, and Aave got 4 points on the lending side. So if it's 4 points, it stays in my category B. If it has less points, I go down and I downgrade the note of the strategy. So sometimes if I land, I don't land again, but it's an example. If I land on a protocol where it's not battle tested, the Oracle is not Chainlink and they use some on-chain Oracle and so on, the liquidity is not so-so. If I want to do it, maybe I will degrade it to D. And it's important for me because D, it means that I cannot put so much money into it. In B, I can put way more money. So it's what I do. And for example, for two strategy, I will give notes to each component. So USDC for me, it's high quality. Lending on Aave, it's B. Aave B, mainnet, it's low risk. Alyra, it's C because it's newer than Aave. But since they already had a hack, I assume that they have poured a lot of money and resources into the auditing of their new code and so on. PT's USDO, I consider that it's a D and so on and so on. So of course, this notation system is very, how to say, it's personal. Like maybe some people, they will feel that USDC SDO is maybe less risky. So when I say that I give you a framework, then you have to adapt it to your own views. Then I take the weakest point because each strategy weakest point is actually its weakest point. So here, if the strategy can be fucked up if there is a problem on this one, on this one, on this one, but which is the weakest point? For me, it's USDO. Here, it's basically the lending. So the strategy here has a note of B. This strategy has a note of D. Then what I do with all those later, I decide the capital allocation. So again, this is very personal. So for example, strategy A, I can put 100%. So strategy A, what is it for me? Staking on Aave, staking on Lido, holding bonds and so on. Then there is a B, holding tokenized bonds, lending and so on, all the way down to the letter F. And basically, if you run a risky strategy, the idea is to don't overpass 5% of your capital or 2% of your capital. But then remember the first things I have told you before. If you want to be diversified and you put a lot of money into a strategy which is less risky, let's say you put 90% of your capital here, and you just put 10% of your capital in more risky strategy, maybe it doesn't worth the risk, because again, if you make 20% but just with 10% of your capital, the performance of your overall capital will be very small. So if you want to allocate funds to different strategy, my advice is actually to don't put too much money in low risk. So to say, big capital in low risk strategy, more capital in lower risk, higher risk strategy, but to be a bit more balanced. So the impact of the rewards here can be bigger on your capital. Then also you have to estimate the percentage of loss, because it's not because the strategy is risky, but if something goes wrong, you will lose everything. So for example, if you do some looping, you have to know what is, if something goes wrong, if you are liquidated, what will be the amount of money you're going to lose. But here you will lose the penalty fee, so you have to calculate how much penalty fee you're going to pay. And of course, if there is, for example, a DPEG of the asset that you use for collateral, and if the DPEG is 10%, which is already very big, how much you will lose. So again, it's not because you put, this is an example for $10,000. If you put $10,000 in a PT and you do looping, if there is a DPEG of 10%, you will lose $700 plus 2.3K, so almost 3K. And if there is no problem but you are liquidated, you will lose around 2.3K. So this is the thing you have to pay attention to. It's not, am I willing to pay to lose 10K? Of course, if there is a hack, you lose your 10K, but again, this is a different story. Here, the financial risk is the DPEG or the liquidation. How much you will lose if there is a problem. So if the maximum I can lose for 10K is 2.3K, I will think, maybe I can actually pour more money into the strategy, because what I care about is the maximum risk I'm taking, not the risk against the 10K investment. So maybe in this strategy, if I'm okay to lose 20K, it's a lot, but maybe I will start my strategy with 100K instead of just 10K. Because many people think, if I have 100K of capital, I will just put 10K, which is 10% of my capital. But again, it's maybe not the good approach, because if you lose money, you will lose 2% of your capital. But if you are willing to lose, for example, 5% of your capital, then you can maybe double your position. So you have to think about this. What is the potential loss that you can do? Some potential loss also are smaller than what you may think. For example, a strategy I really like, I buy a PT, but I don't feel comfortable with the PT. Okay, I don't feel comfortable with the PT. So what I'm doing, I'm checking if I can borrow money against it. When you borrow money, it's actually an insurance. Because if something bad happens with your PT, so you buy it for $10,000, you lose $10,000. But because you have a loan of $9,000, well, you don't reimburse your loan. So it's very bad for the counterparty, of course. You maybe think that you're an asshole if you do this, but this is the risk. Someone is lending you money, again, a risky collateral, they take the risk. So you are on the other side of the trade. So means what I do, I borrow USDC against a PT. If there is a problem, I don't give back the money. So what is my loss? I will lose 10K of my investment, but because I don't give back my 9K loan, I actually only lose 1K. So when I deploy this kind of strategy, I actually deploy way more capital. So I buy a lot of PT, which ensures me, but I do this when the PT is really good, like 15, 20, sometimes 30%. And of course, I can borrow against it on Alyra or on Morpho. And then, if I really not comfortable, I put even more money, and then I borrow money to protect myself. And like that, I have a highly risky asset in a PT that pays a lot, but I protect myself with a loan. And then the loan, I will invest it, of course, in a strategy which is low risk. So for example, I can stake it on AAV in their new umbrella strategy. So again, this, for example, it's an example, but if you put 70% in a low-risk strategy which pays 5%, you're going to make 3.5% per year on your capital. And if you allocate 30% in a risky strategy which pays 20%, you will make 6% per year. So by doing this, you make 9.5% per year on your capital, rather than if you put all your money in the low-risk strategy, you will make 5%. So it's almost a double. So this is the risk-reward. You have to understand that if you allocate capital into higher risk strategy, but not only one strategy. You don't put all your money into one strategy. The idea is that you do, for example, 10 risky strategy, and the 10 risky strategy can make you win 6%, so in total 9%, which this is called the EV, so mathematical experience. experience. So for example, this is what I'm doing. I run a lot of different strategies, which are sometimes risky, but because I run 20 strategies and I put my capital into all those strategies. So let's say I run 20 strategy and 2 of them goes to 0. So I lose everything. I'm still profitable. Just finish with this one. If I run 20 strategy, 18 of them are profitable and they make 20%, and on 2 of them I lose money but only 10%, then the reward is 17%. Versus if I run 3 low strategy, I will only make 5%. So this is the way I think, and voilà. Thank you. So quick question if someone has one. If no, as I said, I will just share my details. It's here. So here you have all my links. Again, I have Excel spreadsheet for who is interested. I have a video that explains how I'm using the Excel spreadsheet. I may not answer this week because it's a mess, but next week I will answer to you. And if there is no question, then I wish you a good day in Cannes.